Namaste to all. Uh, I welcome you all on this evening on behalf of the Taxation Audit Quality Review Board. This is the third webcast in this series during this current council year or financial year. The first two webcasts were basically on the commonly found errors in section 44AB related audit procedures and Form 3C and 3CB. Form 3C and 3CB, and we had two webcasts on the same. This webcast is on a panel discussion mode, wherein we will be talking about the clauses 1 to 15. Though the title is saying 1 to 21, we will be talking about 1 to 15. 1 to 15 clauses of Form 3CD. We have discussed about 3CA and 3CB. So we will not be talking about 3CA and 3CB, and we will be restricting our discussion on clause 1 to 15. And we have with us one of the speakers and the panelists, C.S. Satish Agarwal. He's got experience, regular faculty at various places, NIRC and various other forums throughout the country. Also, he's a regular presenter at ITAT, CIT appeals level. So he has got a great experience into the taxation area and got more than 37 years of experience. So we welcome you, Satish Agarwal ji, in this Taxation Audit Quality Review Board. We have our co-chairman, C.A. Ranjit Agarwal ji, who is a senior in this council to me. This is his sixth year in the term, and he has been guiding all of the council members. Me particularly, I would say I am blessed that he guides me as and when, wherever required. And this year, though his name is synonym with the UDIN and the Code of Ethics, but he belongs to Kolkata, and this year he is not having any standing committee, but a part of non-standing committee. Is not a part of any non-standing committee as the chairman, but a part of standing committee. All the three standing committees: the examination committee, the finance committee, the executive committee. So this year, the current examination which has been conducted, Ranjit Bhai has wholeheartedly worked day in, day out to make this examination possible, and made it possible that ICAI is the first institute in the whole country to have the examination conducted in a very smooth manner throughout the country, I would say, at 164 branches, more than 700, 800 locations having conducted the examination without any trouble. So thanks to Ranjit Bhai and his whole team, I would say, and also all the branch managers out there. He is also the Vice Chairman of Board of Studies Academics. Along with, of course, he is the Vice Chairman of this Taxation Audit Quality Review Board also. Last year, he was the Chairman of this Taxation Audit Quality Review Board. So I invite my co-chairman, C.A. Ranjit Agarwal ji, to say a few words about initially the board, and then let us take to these 1 to 15 clauses we'll be discussing further. Ranjit, by all yours.
Thank you, Chairman Pramod Jain ji, very knowledgeable, very experienced, very dynamic chairman of our institute, and is a very good addition to the council this term. This is his third year in the first term, and he's heading this Tax Audit Quality Review Board as well as International Taxation Committee of the ICAI, which is a very, very important committee of ICAI. And Pramod ji, as is known to rest of the world for a very knowledgeable experience throughout the day, he begin imparting and disseminating the knowledge to the entire faculty to the best of his capability and ability. So thank you, Pramod ji, for guiding and sharing your knowledge with the members. Satish ji is very huge experience. As I was saying, 37 years, not only that, but in 2008-9, you were the co-opted member of the research committee of ICAI, also to ITAT and other forum. So, sir, welcome to this Tax Audit Quality Review Board. We could have a very enriching sharing of your experience with the members. Already 1,500 members have joined this webinar online. And as far as this Tax Audit Quality Review Board is concerned, this is the new board. In 2018, the Institute has set up this board just to enhance the quality of the tax audit reporting done by our practicing member. And in the process of enhancing the quality, we also give some guidance and some advisory to our members what are the best practices as far as reporting of tax audit is concerned. And there is a three-tier structure of this board in which the taxation audit report of the member are picked up. They are scrutinized at three levels, first by a technical reviewer, then by the tax audit group, and then by this tax audit quality review board. And based on this three level of review, we give some advisory to our members to where they have to improve the quality of the reporting. And if there are some gross negligence, some severe negligence on the part of the member, then those cases can be referred to the disciplinary committee also. So by and large, this board is last 3 years, and on average 100 reports are reviewed by this board, and we are very happy that we have compiled a common error. Common error, while reviewing all these reports, common error we have compiled, and we share with the member that these are the common errors in all these 44 clauses when you are reporting, and this should be avoided. And in addition to that, this webinar is in that direction, that how you can improve your quality, how you can mitigate the small errors, and how you can enhance your quality so that the reporting to the taxation authority can be considered as a conclusive evidence on the part of the SSE, and no further scrutiny is initiated on their part. That much of accuracy in our reporting should be there. So with these words, I welcome once again all of you in this very important webinar, third webinar in the series. Today we will take up all the 1 to 15 3CD clauses. What are the common errors? How small mistakes are done by the member? What precaution they should be take care? And what are the key issues in narrating or explaining in those reports? All the two experts, Pramod Bhai Jain and Satish Ji Gupta, will explain. So Pramod Ji, can we start with the clauses, or you can have before the clauses your opening, some issues are there and you will take up, or we should start with the
let us go. Otherwise, if anything is left, we will take the questions of our members. Let us go clause-wise, clause 1 to clause 1.
So thank you. So basically what we have, as you are saying, this 3CD are divided in two parts, part A and part B. So part A consists of 8 clauses, and 8 clauses are very basic, but sometimes these basics are very, very important. So the first clause talks about the various, first clause talks about that name of the SSE. So what is the different, or what are the issues in this name of the SSE? Any point you want to highlight, Pramod Ji or Satish Ji?
Friends, first of all, Pramod Ji and Ranjit Ji, kindly permit me to thank both of you for the introduction. I don't deserve all that what you have said, but I am grateful to the chairman and vice chairman of the Tax Audit Quality Review Board, because without it cannot claim that we are, as a fraternity, capable of achieving the objective. What is the objective of the tax audit? The objective of the tax audit is to get information for the assessing officers, as we have rightly said, in a standardized format, and if that standardized and streamlined information is available, the scrutiny of those cases may not be undertaken. You see, the emphasis is on compliance, and it has to begin in this faceless world from whatever we submit, because that is the beginning and also the end. Now, there is no interaction as per the scheme, so that is a separate matter altogether. So with this words, and I also want to say good evening to all my friends, and also offer my heartfelt condolences to my brethren who or any of their family members lost their lives during this COVID-19 pandemic. I'm sorry to bring this. We all want to forget it, but still I feel it my bounden duty to express my condolences. With these words, I would like to start. Pradeep Bhai has already started and said that the first 8 clauses are basic clauses. They are more informative than taking specific reporting requirements. These are the basic requirements, basic particulars of the SSC. Now the first clause, I will be taking 2 clauses, if you permit me, together. Name of the SSC and address, because they are almost synonymous. So name of the SSC, of course, we know that name of the SSC is A. Suppose there is a change in name, so we could write formerly so and so, and name of the SSC is as simple as in whose name the PAN number is there, because we are doing tax audit. Second, address. Now this is an issue where there are a lot of controversies as also difficulties. Before I begin, I would like to mention one judgment of the Supreme Court. In this case, the Supreme Court overruled Delhi High Court and all courts to state that whatever is the address given in the PAN, if the notice is served at that address, that will be treated as the sufficient service of notice. So here, the address is very important. It should not be taken as a mere formality. We must ensure that the address which is given in the PAN is the correct address, and in the tax audit report, we report the correct address not only as per the PAN, but also as per the MCA portal. Now, this address in this present regime is also likely to be of different places. I may have a registered office separate, principal place of business separate. All these things are to be kept in mind, but the address given in PAN and address given in MCA, that should be made the basis of reporting. Pramodji, if you want to say anything, I don't want to say anything more on this.
Thank you, Satirji and Ranjit Bhai. As regarding clause number 1, certain errors which were observed had come to the knowledge. One of the issue was in relation to where the tax audit is done of a branch. So sometimes what happens that a company or a bank is having so many branches, and an entity having branches, and the name of that entity is written for the branch audits, branch tax audits. So if the tax audit is done of a branch, along with the name, it has to be mentioned that it is a branch. It has to be mentioned that it is a branch. And of course, the name should tally along with the PAN as far as possible. Another important thing which Satish sir also talked about is the change of the address. I am talking about the change of he talked about change of the name also. Now, if any change of the name is there during the year, that should not be considered. But if there is a change in the name as on 31st March and on the date of signing of the audit report, then that has to be mentioned. And that should be mentioned in form 3CA or 3CB, whichever is applicable, as well as clause 1, where you will say this name formerly known as this. Whether it is converted from public to private, in that case also, and if there is a change in name, both ways. And that is allowed if you go in because some things are there that if I talk about tax audit report to be issued, we always have been preferring, and we have discussed that along with uploading of this tax audit report on the portal, on the income tax portal, we should give a hard copy, which should not be the downloaded copy of this form which we have uploaded, but a separate, whether it is Word or Excel, our own generate, where we can mention, and we will be discussing when we are discussing these 15 clauses that how it is different. So one is change of the name. If there is a change in name as on 31st March, from 31st March to the date of signing of audit report, because the date on which I am signing the audit report, the name is different, and on 31st March for which I am doing the audit, it has to be different. If there is a change during the year, not to be considered. Similarly is for the address. But the issue is, if I talk about the address, that address change again from the date of 31st March up to the date of my audit report, I cannot give that date, that address change in my uploaded form. Or in the hard copy still I can give. But if it is not possible in this case to upload in my schema, kindly mention that in my 3CD particulars in form 3CA para 3 and or form 3CB para 5 that this address has changed from 31st March to on the date of signing of the audit report. Because when I am signing that date, what was the address, what was the name, that is also to be given. This is my view.
Pramodji, one more issue here. Like suppose in the PAN address is different, and MCA record there is a different address. Then
yeah, it can be there. Very good, very good. So in this case, actually in case of a company, we should mention the registered office address. Though again, basically it has to be principal place of business. Principal place of business. But yes, if it is a company, it should always be the registered office taking from the MCA master data. And if there is a difference between the PAN data and the MCA master data, the assessee should get it reconciled. He should get it reconciled.
no, but whether we should report that there is a change, different address at two places, we should report like this? No.
Yes, I think so. In form 3CA para 3, I recommend that it should be mentioned, the address. Satish sir wants to add, I suppose.
Sorry, sir, my connection got lost for 2 minutes, but I would like to say two things. Actually, registered office may not be always the principal place of business, in the sense that certain state governments insist that the registered office be in their state. Well, I am telling you of the practical issue. Somewhere in Odisha, in a small place, Sambalpur, let us say. But the principal or the administrative place of business, let us say, is in Bombay or Kolkata or Delhi. Now, in these circumstances, my sense, now this is my sense, you have gone through, you have done all the research on it, would be to mention both. If registered office address is to be mentioned, then the principal place of business should also be mentioned, because the companies are permitted by the registrar of companies to give notice of the address at which books of account are maintained. And they can give that.
Satish sir, what you are saying, we concur with that. This is what we have discussed, that in the tax audit, because that is a financial audit that is separate. My income tax return, my address could be separate, but when I am doing an audit, I have to mention here the principal place of business, and if it is in variance with my registered office as compared to ROC, so I don't have in my uploading form to give a different address, two addresses. So in that case, I should mention that in my form 3CA.
Right.
Okay. So the second point is over. Third point is PAN or Aadhaar number. There is nothing much to discuss about that. Clause 4.
No, I have a question, Your Honor.
Okay. Yeah, go ahead.
For Pramodji, I am sorry, I am used to saying honor because of arguing in the tribunal. You see, if somebody has more than one PAN and they are not, one of them is not deactivated, and in earlier years some return is filed on a different PAN, this year it comes to his notice that there is more than one PAN. So I am asking a practical issue now, whether that my question is part of this clause or not, I am not very sure. But since I am not going by the textbook, I am going by the actual situation where I come to know this year, because you all know that earlier PAN application was asked to be filed while filing the return in the regime 7-8 years ago. And the SSC does not know he gets 2 PAN numbers. And he also doesn't know he has 2 PAN numbers. Suddenly, there is an intimation that your PAN is deactivated. Both are deactivated, not one. That is what the CPC does. So what PAN we should mention there, or how do we write that?
Very good question, Srish sir. Very good issue which you have discussed. Now here, very rightly, there could be cases. Now it is not about activation or deactivation, but suppose what you are saying that assessor is having 2 PAN. Of course, he'll have to surrender 1 PAN. He should not have more than 1 PAN. Having more than 1 PAN, there could be a penalty thereon. But here on, if I say if he's having 2 PAN and he has not surrendered the same, the PAN on which he has been filing his ITR and is going to file the ITR for this year, which is more important, because I am doing the audit of that. The practical issue would be there, shifting of data of the old, but PAN of which I am doing the audit, for which the ITR would be filed, should be mentioned, along with the very rightly you just pointed out that very important point, that the another PAN that should be again recorded in Form 3CA or 3CB where it is.
Right, sir. Thank you.
Thank you. Now the clause 4 talks about whether the SSC is like liable to pay indirect tax like GST, service tax, high duty. So in that case, please you have to furnish the registration number or CGST number or any other number for the same. So what are the issues in this regard, sir?
There are 2 issues. One issue is that in clause A, we have to furnish the registration number, etc. And also, we have to state whether the SSC is liable for any indirect tax, whether it is registered in that or not. Now, as far as the first clause is concerned, a person may have multiple VAT registrations earlier, now GST. Custom duty is of course one. Custom duty normally does not have a registration number. This is a code number. Now, GST number, if I have 20 registrations, 10 registrations, more than one, then all have to be indicated. And same is the case with VAT. Then now most of the indirect taxes are subsumed in the GST. So therefore there is less of difficulty. Of course, in certain items, excise duty is still there, and that also has to be mentioned. But strangely, there is no definition of indirect taxes. Now, there is no definition of indirect taxes. I would like to go by the common meaning that what is not a direct tax is an indirect. So wherever there is a registration, see, one cannot put statute to test on everything. You see, there are certain issues which are not defined, and I beg your pardon, since being an arguing counsel, we always try to find some controversy or the other somewhere. So that is not the intention. The intention is to clarify the issue. So anything coming to that should be mentioned there, and wherever there is a registration, that registration number should be there, because now registrations are PAN based. So the department has a data on the basis of PAN. A GST person can view 26 years. A 26 years now has the information which can be used by the GST auditor. So all this will help in ensuring that the assessee is able to get all the information, the department is able to get all the information at one place. It does not have to search. And if there is no mismatch in any of the information details in customs, GST, etc., you can be free from scrutiny. Pardon my all this, but I must share with you one experience. We received a notice last year for one of our assessees, wherein the notice, faceless notice, specifically mentioned that you have made purchases from A of X amount, whereas in its GST return, that vendor is showing X minus 1. So therefore, the data has to be correct and robust. So this is small that I want to say. Pramodji can point out the errors because, yeah.
Thank you, Satishji. Now, this clause 4, rightly pointed out by Satish sir, has 2 points. First, whether he is liable to pay indirect tax or not. And second, if yes, then give the registration number or any other identification number. So it is not merely registration number, it could be any other identification number, like in customs, what Satish sir said, it could be an identification number out there. Now, few points out here. First of all, that it was observed that if a company is having or any entity is having various registrations under various laws, that kindly ensure to check it from the Caro report. Because what was observed that in the Caro report, registration or non-compliances or compliances of various indirect taxes were given. But when the registration was talked about in this clause 4, they did not talk about all the registrations which were given in the Caro report. So a cross check out there. Now, what is an indirect tax? Of course, if I say a levy is not an indirect tax, so it may not be an indirect tax. But what I assume is that indirect tax would be a tax which is collected and then paid. So it comes all my custom, excise, service tax to any of GST and VAT and state excise and all other indirect. Now, another point which was observed, that suppose a person is having branches at so many places and he has not taken registration thereof. We have seen cases where a person is having turnover of 50 lakhs or 80 lakhs or 1 crore or even 20 crores, having exports, not having the registration number. Is he liable to have registration number? Yes. Has he taken? No. So in case it is not taken, then I have to mention in that actually the column is there for the registration number or identification number. There you can say yet not applied or not applied. Not applied out there. Another point, it was what was observed that now, as very rightly said by Satish sir, that these registration numbers are PAN based. So what was observed that my PAN, the PAN of the assessee is different, but the registration numbers given, the PAN numbers were different. So these are certain small points which I should, as an auditor, take care that if I am giving the registration number, it should be same PAN. And if it is not so, then the registration number, it was an old PAN, I have got the PAN amended, or it was a converted PAN. It could be a case that company is converted into LLP. So in that case, the case would be different. If I am still using the old GST number, which is not correct, then my duty would be there to report. Because the company is required to have the registration number and it is not having a registration number. So these things an auditor will have to take care. He will have to take care.
Okay, so Pramodji, you mean to say that in this clause, suppose I have a state SGST number in 30 states, then I have to mention 30 number here.
Yes, sir. In the schema also, you can, there is a drop down list, they will give you the state names and you can choose it again and you will put it.
Okay, thank you. So now moving forward, now this clause 5, 6, 7 talks about status, previous year, assessment year. So I don't think there is nothing much about it. But the clause 8 is very, very important. We say, mention the relevant clause of...
अरे 5 मिनट बात कर लेते हैं.
5 और 6 की बात कर लेंगे. छोटा सा है लेकिन एक लाइन तो कर देनी चाहिए. मिस नहीं कराएंगे.
बोलिए सर.
बोलिए.
Clause 5 requires the status to be mentioned. Now, status would be person as defined in section 231 of the Act, of the Income Tax Act. Now, that may be individual, HUF, company, firm includes LLP. Now, here, body of individuals, association of persons. Now, I have witnessed or I have seen number of cases, especially of trusts, where the status has been wrongly mentioned. Now, I am not talking of a charitable trust where tax audit is not required. I am talking of a private trust. So, in many cases, the status is not correctly mentioned. That is what, from practical experience, I am telling you. And also, in the status, there could be an issue of a local authority like Noida or a university, etc. All these definitions have to be properly seen. In fact, there is a Supreme Court judgment on the issue of whether Noida is a local authority or not. So, that was with reference to applicability of TDS on payment made to Noida authority. So, therefore, this status clause is equally important to ensure that correct status is mentioned. So, from my experience, I gave one example. Pramodji can give more examples.
Satish sir, what was held in that Supreme Court judgment, whether Noida is a local authority or not?
That was basically, they said it is a local authority because it was a question of payment of some development charges, etc. to the Noida authority without deduction of TDS. So they said no, there is some exemption. So a lot of litigation went on. This was about 3 years ago.
In status, one or two items. One is, in case there is a foreign LLP which is required to file, get its accounts audited here. So what has been suggested by our guidance note is that it should be treated as a company because it is a body corporate, so treated as a company out there. Another point is, suppose there is a change, because you know what Satish sir rightly said, person is defined and firm includes LLP. But the issue is, if I go into this drop-down box, the drop-down box which is given in the schema, it is totally different because that is not notified in the form what would be there in the drop-down box. And the drop-down box, we should choose the nearest status. For example, firm is separately given, LLP is separately given. So if it is an LLP, choose LLP, not a firm. Now, local authority is separately given, corporate society is separately given, cooperative bank is separately given. So as close as possible when you are going into that schema online filing, choose as nearly as possible. And in case of change in status, you have converted a firm to LLP. So whatever is the status as on the last date of the year, 31st March, choose that status because it would be filed as on 31st March, so that status.
Now, if you permit me, could I say something about previous year?
Yes.
A little bit.
Yes, sir.
Previous year, now, for a ongoing entity, that means which is in existence since the preceding previous year, will be 1st April to 31st March uniformly. However, if I have started business in between, let us say from 1st December, 1st January, etc., my previous year will begin from that date on which I start my business. So, in that case, we will have to mention the previous year beginning from that date till 31st. That is one. Second, there are a number of cases of demerger, amalgamation, or as rightly pointed out, conversion from company to LLP that has been a latest trend because of the so many compliances. That is not the subject matter, but anyway, that is incidental what I said. So therefore, in those circumstances, the previous year again could be different. So that previous year uniformly is for those who are already in existence and there is no change in that form. But if there is a change, then previous year has to be with effect from the date the entity comes into being or whatever amalgamation date, etc. is there, beginning from that to the 31st. So this is in short what I had to say, but the errors probably would be the same. Non-mention of the date from which the amalgamation took place, etc. And moreover, now I have a question from Pramodji, which Pramodji will answer, is that in cases of amalgamation, the order comes 1 year later or 2 years later. But the effective date is of 1 or 2 years ago. Now, I have faced these practical issues. Of course, I have guided the people how to move forward. But then, I have already given my tax audit report, let us say for 31st March 20, by the due date of September 20. Now, in March 21, I get a NCLT order or a court order earlier that your effective date and scheme of implementation is 1st of April 19. And then when I make this tax audit report, I am to make the tax audit report of a amalgamated entity. I am not making a tax audit report of the entity, and whatever tax audit report or return that I have filed, what is the fate of that? As far as auditor is concerned, he didn't know. Why I am asking this question is, this question has been put to me and I have given an answer which I would like you also to say. My answer was, I am discussing freely, not that I know everything. My answer was that when the tax auditor prepared that report, it was an entity, he gave that report. And even assessment could have been done under 143 or even the processing could have been done. Now, a specific request is made to the department to, on the basis of another judgment of Dalmia Bharat, that it will make reassessment of a consolidated entity. Now, tax auditor, when he does an amalgamated report, does he have to bring all this into picture in 3CA, 3CB, whatever it is, or he has to remain silent?
Sir, Ranjit sir must be thinking, and I think many of the participants will also be thinking. We are talking about clause 6 previous year, जिसमें कुछ है ही नहीं. But so many points which Satish sir has talked about. Good, good.
So we have to discuss for the benefit of the listener.
Conversion during the year from firm to LLP, no issue, but company to LLP, LLP to company. In that case, of course, the years would be different. In case of a company to LLP or LLP to company, there will be two separate tax audits. So, period was there up to that date, the company, and thereafter LLP. Suppose a company is converted on 1st of October 2020. So, two tax audits are required if there is a tax audit. So, for the company, the audit period previous year would be 1st April 2020 to 30th September 2020. And for the LLP, it would commence from 1st of October 2020 to 31st March 2021. So two separate audits, two separate financial statements, two separate returns, and two separate tax audits. Now, second point out here is what Satish sir talked about, that in case of amalgamation where my appointed date is different as compared to the execution date outside, which is the effective date and appointed date, they are different. My effective date is 1st April 2019 and my appointed date is April 2021 or say October 2021. You know what rightly said by Steve sir, that once an ITR is filed, once an balance sheet is filed and audited, in income tax you cannot change, in ROC also you cannot change. For the amalgamated also you don't change. You just file that NCLT order and do it. But still, because the effective date is 1st April 19, the assessment would be done on the merged basis. So you'll have to prepare the merged financial statements, get the merged audit done, merged tax audit and merged ITR.
Right.
Now the issue is how to file it. Now filing, there is an issue because our system, the department which is yet to create about an amalgamated entity. So what to do? In that case, prepare that amalgamated consolidated balance sheet of the amalgamated and the amalgamating entity and submit it physically along with the covering letter. The consolidated balance sheet, consolidated audit report, consolidated tax audit report, consolidated computation and consolidated ITR. File that manually, have an acknowledgement. For the company which has amalgamated, there it would be filed that now it would be nil. And for the amalgamating company, for company which has amalgamated, the amalgamating company, that consolidated will be filed. But another very interesting question, issue I would say, not there, or a partnership firm which is formed or an LP which is formed on say 1st of May 2020, 1st of May 2020, but the business is set up on 1st of October 2020. What would be the previous year? As per Income Tax Act, Section 3, the previous year would not commence from 1st of May 2020. It would be commence on the date of setting of the business of a new entity. So as per Section 3, it should be for the tax audit report, the previous would be 1st October 2020. I don't know how many the tax officers would be able to understand this, but this is as per the Act. So yes, so one has to be very careful about this.
So may I intervene here? See,
Yes,
the difference between setting up of a business is a subject matter of protracted litigation. So the tax auditor will have to therefore become a judge.
and I agree. No, I'm just saying, there is no, I'm not going into the litigation of setup and commencement of business.
No,
I'm
but
saying, just I've incorporated a company. I did not even bring my capital.
right.
I did not open my bank account. So what would be the previous year commencing as per Income Tax Act?
What is the meaning of then certificate of commencement of business? Now they have made it compulsory.
Sir, it is after getting the money to get the certification of business when you file INC 20A. So not on the incorporation.
No. Therefore, I was just trying to sum it up. That can we say that the date of certificate of commencement, for the sake of uniformity and for everybody to understand, that the date of commencement of business certificate can be taken the date to be in the previous year, starting with from that date?
I still under income tax, no.
No. Right.
Under income tax, no.
So now another controversy.
Yeah, a lot of issues out there. Yes.
So Pramodji, this the point you are making that in the aspect, the hard copy has to be submitted. I hope this new income tax portal will take care of that, because we are moving towards stressless assessment and stressless appeal. So this hard copy concept will be discontinued in the times to come. I hope so.
We are also hoping, sir.
Yeah. So this is the point number 7. Now can we come to clause number 8?
Yes, sir.
7 is
Okay.
nothing to comment. Assessment here. 8, sir.
So clause 8, sir, it says कि you mention the relevant clause of section 44AE under which this audit has been done. So what could be the relevant clause of section 44AE? It's a very important because many members put at something. We have seen many common error in this clause.
Just simply state what is required to be done. Pramodji then will deliberate on what are the errors and then if there is anything further to add, I'll add. So clause 44AB requires, first of all, we need to understand the audit for a business or profession if the receipts are more than 1 crore, whether it is cash more than 5% of the total payments and receipts. If the number is up to 10 crores and 95% of the receipts and payments, mind you, this may include cash, loan also, it may include anything. It is not turnover. So then the limit is 10 crores. Now, if the audit is conducted for an entity above limit of 1 crore and a 10 crore limit is available for transactions, cashless transactions up to 95%, then it is 44AB clause A. If it is professional receipts, now professional receipts, the professions have been defined. 44AB clause B, I did not go into the professions, but simply to make a point, medical profession, engineering, accountancy, means chartered accountancy, interior decoration, all these architectures, all these are covered in the definition of, and this is similar to the definition in 194J, because we certain time make mistake, a profession is that profession which is notified. And this is relevant also for the fact that books of account have been prescribed under section 44A, rule 6F for profession, not for anybody else. Now, clause C is an audit where there is breach of the presumptive profit that is allowed to an assessee. These are sections 44A, 44BB, etc. I'm not going into those sections. We are just taking the clauses. If I am, let us say, in retail trade and my turnover is 50 lakh, but I want to declare a profit of 3 lakh and this is 6%. So if it is less than 8% and again there is a incentive for cashless transactions, I am not into that example. So instead of 3, I will put it 2.75 lakhs, not to get it confused. If the profit is 2.5 lakhs that I want to declare, then I am supposed to get my books of account audited and I have to maintain the books of account and then get it audited. This is to be reported in clause E. Now, the major error I also find in certain audit reports which come to us, which has come to my notice, is in case of the companies. Because in the companies, the audit is already conducted under other act, that is the Companies Act. We issue the auditor's report, RO report, etc. as may be applicable. Now that is mostly reported in clause A, whereas it is to be reported in proviso to 44A. Now this is the text to my knowledge. I am not adding anything more unless Pramod ji permits me, let him deliberate on the errors, then I will come back.
नहीं सर, आप पहले कर लीजिए सतीश सर.
There's no issue, please tell me. मैं तो देखो controversy create कर ही दूंगा. Don't worry about it. Because otherwise it will become dull and drab. We are practitioners and we are not sitting in a classroom of a school teacher and a student. All our participants are well versed. In fact, some of them or most of them may be more versed. So they may also help us in understanding the things better. So therefore, controversy is a must. But we give you the mandate to clarify whatever the controversies, this is the final word. So your word will be taken to be the final. Ali.
Satish ji, yes, this clause 8, the last clause under the part A, I would say, the basics thing. This clause 8 is again very, very important. And before we started this webcast, many members had posted their queries also, and a few of the queries was also on the clause 8 that there are a lot of controversies currently clarified. So clause 8 very rightly, as explained by Satish sir, various provisions under which the audits are required. Now, what is happening that under this e-filing, electronic filing, various clauses are amended in the drop-down boxes. As on date, what we have, there are 9 clauses, which is there, 9 options which you can select from the drop-down box. There is, of course, 44 ABA, where my turnover exceeds 1 crore, then it is required of the business. 44 ABB, where in the case of profession, whether specified or not, if my gross receipt exceeds 50 lakhs. 44 ABC, then we have C may we have 1, 2 and 3 for all the 3, 44 AE, double B and triple B. So 3 clauses are those. So we have got 5 clauses done. Then 44 ABD in the case of deeming provision, deeming profits under in the case of specified profession under section 44 ADA, and my deeming profit is less than 50% and my gross receipt is less than 50 lakhs. And my total income is exceeding the maximum not chargeable to tax, and then 44 ABD may audit hota. So that clause is to be selected. 44 ABE if it is covered under 44 AD4, and my total income is exceeding the maximum amount not chargeable to tax, which is in the case of individual HUF 2,50,000 and not 5 lakhs. In the case of course, senior citizens 3 lakhs, and in case of very senior citizens 5 lakhs. So we have discussed this 44 AB, these clauses in our last webcast. So that would be made available. That would be available on the Taxation Audit Quality Review Board page of the ICAI.org. If you go on the ICAI.org, go in the committee page, non-standing committee, Taxation Audit Quality Review Board, you will get the webcast all. The last 2, including this also, you will be getting it. Now, the next one comes the third provision to section 44AB. Now, this again point came, it was observed that in the case, because when we talk about the audit report to be issued, what is this 3CD? This 3CD is just an annexure, a particulars annexed to either form 3CA or 3CB. Either 3CA or 3CB. So in case whenever I have to select 3CB, I am issuing a report in 3CB. There I have to choose out of these 9 clauses any of the 7 clauses. Out of the 9 clauses, in my view, the 9th clause should never be used. What is that 9th clause? It says for clause 44 ABA proviso, where aggregate cash receipts and cash payments of the business exceeding specified limits. Now, if I read the provision to section 44 ABA, it says that in case my turnover is less than, in case my receipts and payment aggregate is, aggregate of the receipts and aggregate of the payment is cash portion is less than 5%, then my limit under 44 ABA would increase from 1 crore to 10 crore. So in that provision I am not auditing. मैं उस प्रोविजन में तो ऑडिट कर ही नहीं रहा, मैं तो 44 ABA में मेरी लिमिट 1 से 10 करोड़ हो जाएगी. So in that case, in my view, that 9th clause should not be used. That 1 से 10 करोड़ के बीच में ये कर देंगे तो technically it is not correct. Now remaining 8 clauses are there. So 8 clauses we have discussed. These 6 clauses, 7 clauses. The 8th clause is third provision to section 44 AB. Now if I talk about when we are issuing 3CB, then out of these 8 clauses, you can use any, you have to choose out of these 8 clauses any of the 7 clauses. Any of the 7 clauses except the third provision of section 44 AB. But in case you are issuing 3CA, then you have to choose only and only the third provision to section 44 AB, where it is the audit under any other law. And this is the main difference between 3CA and 3CB, which we have discussed in our last webcast also, that what does the section 44 AB requires? 44 AB requires that in any of these 5 cases, if you are covered, then you have to do 2 things. 1, get the books of accounts audited, and second, issue a report. Then first provision, second provision talks about the other items, 44 AD and 44 B and BBA. The third provision says if the audit is done under any other law, then you need not get the books audited under the Income Tax Act, because you have got it audited and given the true and fair view under the other law. Hence, only the report is to be issued. So when we issue 3CA, we don't give our true and fair view on the financial statements. In 3CA, that column is not there. In 3CB, that column is there. Para 3A, where we have to give our observation on the financial statements to give our opinion whether the financial statements are true and fair or not. So I have to use only and only the third provision when I am issuing Form 3CA. And it is not only companies, LLP also. LLP also. And in case of companies, even 3CB could be issued. Specifically say a company is converted into LLP and you are doing the tax audit. Of course, then there is no audit under the Companies Act. So 3CB would be issued. Or the financial year is different. You know, so many things are there. So I have to be very, very careful about using the appropriate clause when I am issuing 3CA. Only and only third provision to section 44 AB is to be opted for, drop down box, as well as writing when I issue my hard copy thereof report thereof. Satish sir, anything you want to add?
No, I don't have to say anything. In fact, I restricted myself since already you had informed me 3CA and 3CB are not to be discussed. Anyway, the other amendment was made in form that assessees who have opted for sections 115 BBA, 115 BBA, 115 AB, BAC, BAD, etc. These are for companies, individuals or cooperative societies. So I will just take 2 main issues. That the amendment was made sometime after the budget of 20 in October to provide for a regime for companies that if they want to be governed by this low rate of tax of 15%, I am not talking of the surcharge, they can get that opportunity provided they don't want any, and there will be no MAT also, and provided they don't want any tax rebate, ATIC and all those things. So I'm not going into that because that is not the subject matter. Subject matter is that we have to report that if any company is opting for a regime under section 115AB, then we have to ensure that a intimation is to be filed in the online portal whether that has been filed or not. Now that form I have to see, that is copy of form 10IB, IC and ID. Whatever is applicable in the circumstances, that has to be seen and that has to be reported by the tax authority. So it's just a compliance issue. That's the basic objective of the tax audit report. We are to do the work on behalf of the income tax department, though whether they take it at its face value or not, they have the online resources now to verify that has been done or not. But if it is omitted, then it will not be a proper tax audit report on that issue. So that is all I had to say on this.
Thank you, Sri sir. One thing here, I was just browsing through the questions of some of the participants, and one of the question was from CA Prakash Agrawalji from Delhi, a very dear friend. And this question I am taking because this question we have received in various seminars, and various members have asked this, that is, if the audit is undertaking under GST law, then which form shall be used, whether 3C or 3CB, because audit is being conducted. You know, audit of what? Audit has to be of the financial statements, wherein the auditor gives the true and fair view of the financial position, the benefit and profit loss. In GST, that is not done. In GST audit, it is not done. Hence, in that case, it will not be considered as audit done under any other law. And another question which has again been asked several times again here, because this is related to clause 8. And here again it was asked by Mr. Mayur from Rajkot, what to select in case of voluntary audit. Now, please understand, there is no concept of a voluntary audit under any regulation. Under any regulation. If it is a voluntary audit, it is voluntary. It is not under income tax, it is not under Companies Act. We have done out of your sweet will. So if an audit is done, then none of the clauses is applicable. That audit is not done under Income Tax Act. None of the clauses will apply. Your due date under income tax would remain same 31st July. Please understand. You cannot do that. Ranjit sir, any issues you want to add?
So Pramodji, these are well explained, all these 8 clauses. And it was looking very simple, these 8 clauses. But almost 1 hour we have spent in understanding these 8 clauses. So now next 7 clauses we have only 1 hour left. So we have to complete that way. So now very important clauses are coming, Part B. And this Part B are very, very important in the sense that Clause 9 talks about if it is a firm or a AOP, then you should mention the partners, their name and their profit sharing ratio. This is the 9A. And 9B talks about if there is change in the partner or sharing profit sharing ratio since the last date of the preceding year. So you should mention the change also. So what is the issue in this 9A and B of this Part B?
May I begin?
Satishji?
Yes, sir.
Yes. See, these are clauses giving information. First is 9A, which is a firm or association of persons indicate name of partners, members and profit sharing ratio. Why I'm reading this is, the underlined is, and their profit sharing ratio. Now, as partners are concerned, their names are given. And as far as association of persons are concerned, sometimes their shares are indeterminate. So we have to specifically state that their shares are indeterminate. So this is what I just wanted to underline, their profit sharing ratio. Partnership includes LLP here also. And if clause B, taking cue from you, I am being quite brief on this. In clause B, we have to write if there is a change. Since the last date of the preceding year, the particulars of such. Suppose I have done some change in my partnership deed by inducting or retiring or changing the profit sharing ratio, then I have to specify from which date and what change is there. That has to be indicated in this clause. Now, this clause requires us as auditor to take the primary documents. Now, partnership deed, LLP agreement, supplementary deed, all this. So I was just going through the guidance note, which is of 2014, by the way, a new note has not come. It's high time that the institute brings that. There is a lot of changes since then. So I found that a reference is made in the guidance note to a CBDT circular. Of course, now it is history that in case the partnership deed does not specifically mentions the working partner's remuneration, then that remuneration may not be allowed. I just simply said that because that circular refers to a grace of 3 years, because amendment was made in 94 and they say for 3 years we want to give the grace that even if it is not properly mentioned, the remuneration will be allowed. There is a judgment of Bridge and Company of Delhi High Court where also they have very said that the partnership deed should clearly mention. Now, as far as the clause is concerned, there is no mention of remuneration. It is only mention of the profit sharing ratio. What I said only was incident. Now, this is as far as clause 9A and B is concerned. And then again, here the common error would again be, I think, sometimes somebody is representing in the representative capacity. I am a foreign company, then I have a agent here or trustee here or whatever may be the circumstances as per section, income tax section already there is number of representatives, that has to be mentioned in the form. Now, Pramodji, you can take over, sir.
Thank you, Satishji. Here, not too many points, just 1 point or 2 points. One of the point is related to the change in profit loss sharing ratio. If the change is there, so I have to compare with my previous year, say 31st March last year. So last day of the previous financial year of previous year, and then I have to come to the new one. So if there are more than one changes, then I cannot this schema doesn't allow it. Though I can physically give every ratios out there because there is change into say suppose a new partner is added, one on June, one on September, one on December. So my profit loss ratio would change for all the 3 periods. But adding that and giving that, it would be what is required out there is a date of change, name of the partner member, type of change, whether addition or deletion is there, then old profit loss sharing ratio, new profit loss ratio, and remarks. So that you have to see last closing year and this year's closing. Another just 1 point to take care in case of dissolution. In case of dissolution, or suppose you have converted your LLP into company. So in the mid of the year you have converted, or there is a dissolution. In that case, there is no change. Then this clause 9B will not be applicable. 9B will not be applicable in case of such conversion or dissolution. That one has to take.
So Pramodji, one more issue here. Like suppose there is a reconstitution of the firm, new clause has come now. So will that some guideline are not released by the department also so far? So will have any impact here in this clause? No.
Any reconstitution of what?
Reconstitution of the firm because of this some new 9B, this new section has come for this year.
No, what you are saying is reconstitution, that 9B when you are saying, or section 45(4) which has been inserted for that is in the case of dissolution or reconstitution. So dissolution, reconstitution, in that case, if that is only related to the taxation of capital gain or stock in trade when the partner is taking some money of that. So here it will not impact.
So 9, 1 and 2 are that way. 9A and B is that way. It's okay. So now this clause 10 talks about nature of the business of professor. So if you have one or more, then you have to mention if there is any change, then you have to mention the change. So is there any issue here in clause 10A and B?
I will just say what is required to be stated. That's all. you see, the clause simply says nature of business or profession. And if more than one is carried on, nature of every business or profession. You see, so what we need to do here, first of all, we have to examine whether I am in manufacturing, trading, service, or any other category, construction, let us say, broad categories. Then I have to see what is my nature of business after seeing the sector that is normally defined as a sector, manufacturing sector, trading sector, service sector. Then I have to come to the nature of business. I might be doing manufacturing for my own self, or I might be doing job work for others. All these things have to be clarified. And if there is any change, now, mind you, due to COVID-19, let us say, if some factory is closed for 2 months, but because of the financial difficulties or lack of orders, it is closed for 1 year. So, in my view, it is recognized as a lull in business and not a change in business. So, that ought not to be reported as a change in business because this is recognized even by Supreme Court. Lull in business and change or closure of a business are two separate. Now, another issue here would be that I have a business which I changed, let us say, from manufacturing to trading. I gave up manufacturing. That has to be stated. That is a change. I converted vice versa, trading to manufacturing. But these are the broad things. And lastly, I think is the code. The code also is required to be mentioned that I am under which code I am, that specific list is there. And then code is mentioned, that is more of a compliance job to see under which code my business falls. And I think beyond that, there is not much of a thing. We can elaborate on it if we want, but the fact is that we have to see the business that I am operating in, if there is a change sector, and suppose I am into 10 businesses. Now, that may be segments. Let us say I am manufacturing electronic components. So that is sufficient. I may have 20 type of, motor parts, or I may have 30 types of hardware items. So my description of business hardware is sufficient. I think
very rightly, Satish sir, you are very rightly said. The main thing which was found by the board also, that assessees and many times are not giving all the principal line business, all the line of business. Suppose there is a manufacturing and certain service activity also. So service activity is missed out, which is very relevant from the the statement of profit loss itself, that you have got more than one line of activities, business activities. So give all, and very rightly said, a temporary lull or temporary suspension is not a change in the business that one has to take care.
Okay. So this business 10A, 10B rightly put by both the speakers. Now, sir, moving forward, this clause 11. Clause 11 talks about books of account as are prescribed in the section 44AA. So if yes, you have to mention the list of the books of account or list of books of account maintained and the address at which books are kept, you have to mention in this clause. And many times this clause also talks about list of books of account and nature of relevant documents examined. So there are 3 points here, one, A, B, and C. So, and you also mention here, because the books of account are also mentioned in the, like a digital platform on clouds. So in that case, what will be the recourse?
Sir, I would like to begin by saying that we have to understand the difference between the 3 clauses. First is books of account as per 11A are prescribed under 44AA. So as I mentioned incidentally, these are prescribed only in Rule 6F for professionals. Now, what are those? I am not going into it. So the auditor has to mention that books are correct. Now the next question is, as far as other assessees are concerned, CBDT has not prescribed any books of account. But we have to understand the meaning of books of account from the definition given in the Income Tax Act, which says what are the books of account, mentions ledger, cash book, etc. and also speaks about the books of account maintained on a computer generated system, which also has to be read with the definition given in the Information Technology Act 2000, which is not mentioned in the Income Tax Act. So your question will be answered by the Information Technology Act definition, which overrides all the acts as far as that definition is concerned. Now, this is as far as prescribed is concerned. For assessees other than professionals, no books of account are prescribed. Now, the next question is books of account maintained. Now, we have to mention the books of account maintained. For example, cash book, ledger, sale purchase register, etc. or production register, stock register. Now, these are the 4 or 5 primary documents that are maintained. Now, the next important question is books of account examined. Now, there could be a difference in all 3. Books of account prescribed for professionals may not be maintained. There may be deficiency in maintaining the prescribed books of account. Now, third is the books of account examined. Now, this is where the reporting requirement and the responsibility of the tax auditor comes into the picture. A person may have maintained stock register, but when it's a question of examination, it may not have been produced. I am giving a practical example of a raid case where this happened, and this question was put in the tribunal that the books of account mention stock register, but the tax auditor has not stated in the books of account examined the stock register. So therefore, we set aside the issue to the file of the assessing officer. We cannot take it at the face value of the assessee that the books of account stock register maintained is in order. So why I am giving this example is that examination of the books of account maintained necessarily has not to be same. A production record may have been maintained, but it may not have been examined for whatever reasons, due to being in a village, due to not being made available, or whatever may be the reason. So therefore, the distinction between prescribed, maintained, and examined has to be carefully kept into mind while reporting. And then also, it is to be clarified whether books of account are maintained in computer generated system or not. That also is a must. Now, the other issue where I find there is normally a lack of reporting is whether the primary record like bills, vouchers, or other record of similar nature has been examined or mentioned or not. Now, as per the guidance note, what I read, and of course, what is the normal practice also, these are all examined. Without examination of these, if you are conducting an audit of a non-corporate entity, as Pramodji rightly pointed out, you cannot certify the true and fair view. So, if you cannot certify the true and fair view, you have to mention here that these records have been examined. If you have examined, of course, if you are not examined, I am not saying that you write that, but then you have to mention here. Now, the question of cloud that you raised, I think I have shortly answered that, but let Pramodji elaborate it on further. That Information Technology Act, Section 4, says that books of account maintained in whatever form, magnetic tape and all those blah blah, whatever it is, that will be treated as a valid books. I hope I am correct, Pramodji.
Yes, sir. Yes, sir. Now, friends, few points out here and certain interesting points, and that, to be very frank, came to my mind when we are, because normally what we happens when we don't talk about these first 11 clauses normally. So clause 11A, when we say whether books of accounts are prescribed under section 44AA or not, then yes, in case of business, very rightly said by Satish sir, that yes, it is not prescribed in the case of business. And in the case of profession also, only for the specified profession, not all. Only for the specified profession which is given under 44AA1. But in the clause A, we have to mention what are the books prescribed for chartered accountants, let us say. Books prescribed? Yes. What do we write? Cash book, bank book, ledger, journal. Is it so? Are we writing so? So, client register and all those things. The books prescribed as per rule I have to mention. And what are those? That are for all the professional, specified professional, only 4. Not bank book, cash book, journal, bills, incoming and outgoing, some photocopy and this. So we have to mention books prescribed only those 4. In case of medical, further to the client register and the daily register and the inventory. These are the only books prescribed for the professionals. No other books prescribed. We cannot write bank book or something like that because these are not prescribed. I don't know why they have asked it, but yes, what are the books prescribed? They want to have, because there are 2 classes of professional. Medical, 2 books extra they have required. Now, coming to B. If you are a professional even, then it could vary that you have maintained not only the books prescribed, but furthermore, or have you maintained the books which are not prescribed? Suppose in the case of doctors, in the books prescribed, you don't mention those inventories or we don't mention the client register, then there could be an issue in the later stage. So I have to mention what are the books prescribed. And it says, in case it is maintained in the computer system, mention the books of accounts are generated to such computer. Now, when we started this discussion today, I said that you cannot just issue this soft copy. Why? Because it says that you have to mention the books of accounts, that they have been generated to computer. There is no place given in the schema. For that, you will have to issue a hard copy and write that it is generated to computer. I cannot help. The question which the answer is there, which is notified form 3CD, the uploading thereof. So I need to take care. I prepare my 3CD and from that data, I upload that. So one point I just wanted to bring out that. And yes, of course, books of accounts which are maintained, in case it is from computer, mentioned in your hard copy which you are issuing. In case the books are not maintained at the registered office in the case of the company, kindly as an auditor ensure that the company has intimated to the registrar in form AOC 5 that they have maintained the books at some other place. That is the requirement under the Companies Act. But the beautiful thing is that, as Satish said, that the stock registers are maintained. Now, clause B and C, the difference is, clause B, if the stock records are there, you have to say, yes, it is maintained. But whether you have examined that or not would be in clause C. So, assessee says, I have maintained. Examined, I have not examined, they did not produce before me. It could be that way, na? So it is not that it has to be same. And of course, what was observed that in the books examined when we say, because here the books when we say, I have to see the definition as Satish sir talked about, which is given under the Income Tax Act, and that includes my vouchers and others. That includes my supporting relevant documents. Invoices, receipts, voucher, bills, secretarial confirmation, certificates, internal, external. I have to write all those. What are those maintained? So that it was observed that it is not mentioned. And as regarding my maintained on a server, cloud accounting, now very under the income tax, currently they have not visualized that per se, but I feel so, because it is not mentioned about that. But under the Companies Act, they say that in case it is maintained on computer, the server should be located in India. All those things are there under the Companies Act. Now here in this case, because if I say books where are maintained, if it is maintained to computer, my say registered office is in Gurgaon, or in Delhi, my corporate office is in Gurgaon. I've got 10 other places, and everything is on SAP. So books are available everywhere. But there could be certain manual books which are maintained at different places. For example, my stock register at godowns, separate godowns. So those locations, what the books are maintained, kindly refer that. If it is centralized, then at central places, and there is no specifically it is mentioned where the server is located. But I would here, in my view, whatever we are discussing, Satish sir, me and Rajit sir, these are currently the views of our personal views. Only the commonly found errors is of the board. All others are our personal views. In that case, in Form 3CA or 3CB, we should mention where the server is located, which could be at other than the registered office, because here it is not mentioned. So if I am issuing a hard copy, mention that where the server is located in case of the cloud computing, so cloud accounting.
I will just add one thing, just one thing on the server. In fact, the location of the server reporting is very important, because the amendment in the Act for levy of equalization levy is based on the location of the server. So the Act understands the location of the server as the location. Of course, we are talking of a Indian territory and international territory, but location of the server would help. I just want to say, because whatever is not mentioned in 3CD or anywhere else, we have to take cue from the scheme of the taxation.
So international taxation community understands that, and that equalization levy is not under the Income Tax Act, that is under the Finance Act. So all those things are all.
But of course, we can take help from that to say that mentioning of the location of the server is important.
Is important. Agreed.
That is what I wanted to make the point. I was not discussing the international taxation or the equalization levy, because after all, we need to come to some sort of consensus.
Agreed.
So this location of the server, in this regard, we have to take a certificate from the client that where it is located, and we have to mention like this. And since it is not part of the guidance rule right now, because the guidance rule 2013-14, so it is under revision, and it will be incorporated because the guidance note is under revision. And one more, this common error we have seen, that books of accounts examined and the relevant documents in this regard. Most of the reports, there is no mention of that aspect, so that has to be considered.
Right, sir.
Very nice.
Now, Pramodji, coming to this clause number 12, this is also very, very important. This says whether the P&L account include any profit and gains on presumptive basis, 44 AD, whatever AF. If yes, you have to indicate the amount and the relevant section. So there are many issues in this regard also, while common errors are there. So Satishji, what is your comment on this clause 12?
See, the clause looks very innocuous and very simple. But as you rightly said, Pramodji has delivered one full lecture on this. So I will leave the lecture part or the controversy part to him. But I will just state what is required. As far as the reporting requirement is concerned, there are sections mentioned here under which presumptive taxation is admissible. Section 40, presumptive taxation is allowed I mean, a person can opt for presumptive taxation. So those clauses are 44 AE, AF and all that. Not repeating that because that is not the intent of the lecture. What it means is that a person who has prepared a profit and loss account, it is envisaged that he may have a business other than presumptive business also. So his profit and loss account is prepared. Now the reporting requirement is whether this includes any profit and gains accessible on presumptive basis under those respective sections. In case it does not include, there is no issue to report. It is as simple as that. We simply have to say it does not. Now the next question is that as far as the profit is concerned of a presumptive business, 44 AE, let us say, I am taking 44 AE. Now, by the definition, 44 AE does not require me to maintain books of account, right? Now, how I record that, whatever amount I have recorded, I don't know whether it can be verified or not. But anyway, since the reporting requirement is there, suppose as per 44 AE, my presumptive tax income, turnover or whatever you say, but or whatever they find out is, let us say, 5 lakh rupees profit. My profit and loss account is assumed, says profit from such business is 20 lakh rupees. So I have to state that the profit from such business of 44 AE is rupees 20 lakh. I do not have to comment or to align it with the tax or the income that I am declaring under section 44 AE. This is the precise, in my view, the intent of the clause. Now the practical difficulties, controversies and other issues are quite a lot in this clause because it will come up in the queries or Pramodji can take up, because otherwise we'll spend half an hour on this. It will not end because business 60 lakh turnover, 50 lakh presumptive tax turnover, how to do it, what to do it. So that is, I think, a separate chapter itself. So I will be restricting myself only to the reporting requirement. Whoever Pramodji wants to add, let it.
Very rightly, Satish sir, we are not going into the relevant sections. The only thing is the profit loss, the books of accounts which the auditor is auditing.
Right.
Whether that includes any presumptive incomes or not. Then if yes, then I have to mention the section and the amount. The only thing is how that amount is derived. If it is in the books of accounts, the basis is proportionate or it is separate ledger account that you can arrive, and if there is any non-confirmation, your view is different and the assessee view is different, then mention that appropriately, that the assessee's view is there and I could not calculate it on a proportionate basis or I am not convinced about that. So that the auditor has to take care of.
Okay. So, no any other comment in this point?
Nice, sir.
Okay.
No need to comment.
So now moving forward, the clause number 13. Method of accounting implied in the previous year, or if there is any change, then you have to mention the change also. And if there is any change in affirmative, then give the detail of the change, how to the effect, and when these adjustments are required, then all this ICDS and all these things are. So it's a very important clause as far as reporting aspect is concerned, profitability aspect is concerned, loss aspect is concerned. So we have to deliberate in detail on this clause 13.
I will be trying to be as brief as possible because otherwise it itself is a one lecture, clause 13. So first of all, method of accounting. An amendment was made and now only two methods are recognized, cash and mercantile system. Mixed system of accounting is no longer legally allowed. As far as Companies Act are concerned, even though we are deliberating on the Income Tax Act, as per Section 209 earlier and 128, 129 now under the Companies Act 2013, only mercantile system of accounting is permitted to corporate entities for maintaining their books of account. So method of accounting has become, as far as reporting requirement is concerned, quite simple. Whether it is cash or mercantile, and for companies it is supposed to be mercantile, but if somebody is not following it, then the qualification is there under the Companies Act, and we have to mention whatever it is being followed. Now, the next question is change in method of accounting. Now, change in method of accounting and change in accounting policy are two different issues, and there is a fine distinction between these two, which has to be clearly understood. Now, change in method of accounting may not result in change in accounting policy or vice versa. Now, change in accounting policy could be simply that I, follow FIFO method of accounting for inventory. I start the average method. Now, that is change in accounting policy. That is not change in method of accounting. So that will not be required to be reported here. Now, change in method of accounting, what is the example? The change in method of accounting could be that earlier I was recording in my books of account. This is on the basis of a reported case. I am not taking the name of the case because that is not required. I am picking up the fact from there that I was earlier accounting for providing incentive to my dealers on the basis of the figures reported by them after the closure of the financial year, maybe after the finalization of my balance sheet of that financial. But due to change in the GST and the need, I am not an expert on GST, but this is what I was told, due to the need not to issue debit credit notes more than 6 months old, etc., they changed the accounting policy of accounting for the incentive. Now, this is also not change in method of accounting. This is again change in, because earlier also they were following the mercantile system of accounting, but this was continuing and this was being allowed. Now, whatever it was, now they have changed the policy to account for the incentive pertaining to that year by making a provision in that year itself, though that is not accurate. So what they do next year, they reverse it as it is, and then whatever the changes are, they make next year. So there is a very minor difference, but that is permitted. Now that is change in accounting policy. So we don't have to mention about that. That is significant accounting policy already there in the ICDS. Now, the next question is change in method of accounting and the effect thereof. Now, effect thereof, if it is feasible to compute, we can get that. If it is not feasible, then we can simply say that it is not feasible to compute, and most of the time it may not be feasible to compute the impact of change in method of accounting. Now, it is not that method of accounting change is not permitted. Bona fide change of method of accounting is permitted. But why this clause is there is to make sure that people don't change overnight from cash to mercantile and mercantile to cash. I will give you an example of a publication house. What happens? They send the performer invoices to their subscribers of preceding year. And on that basis, in the March ending, on mercantile system of accounting, they book their subscription income as a matter of routine. But every year, they had to write off bad debts. So it became a very difficult proposition. So it is not a company I am talking of. So what they did, they decided to change the method of accounting to cash system of accounting for recording the subscriptions for their journals. Now that is a change in method of accounting. Now that has to be reported. And what is the impact of that? If you are able to capture, you have to mention. If you are not able to capture, then you have to say it is not feasible. Now that is as far as the method of accounting is concerned and accounting policy is concerned. Before I go to ICDS, there is another issue which is I will touch briefly because it's already 7:45. That is the method of accounting has been tried in section 145A. There are 4 clauses and I find the closing stock inventory valuation as per the section is required to be done on inclusive method. Though there is no difference between inclusive and exclusive method as far as profit is concerned. But the notional exercise is required to be done, which in 95% of the tax audit reports, or Murthy can vouch, you will not find, except for listed companies, etc. Because you have to include the duties first in purchase, sale, stock, etc. and then reduce it. Though in both it comes out the net figure to be same, and there is a Supreme Court judgment on this also, British Paints Limited, which has said that whatever method is being followed is all right, but as far as the guidance note is concerned, tax audit report is concerned, we are required to prepare that according to this section 145A. Now with this, before it becomes too lengthy, I would like Pramodji to give his comments because ICDS will take after his comments on this.
Sir, let us discuss about ICDS also. We will not go into ICDS, each ICDS.
Right.
Only reporting. What does ICDS contain? Let us not talk about that.
Right.
Let us not talk about that.
Okay.
Only what is to be reported, let us talk about that.
Okay. Then I will cover that also very fast. Now, in this, there are 3 clauses. This is whether any adjustment is required to be made to the profits or loss for complying with the provision of income computation and disclosure standards notified under section 145(2). Now, 8 ICDs have been notified to be reported, though there are 10 ICDs, 2 ICDs on securities and on exchange fluctuation that are not required to be reported in the ICDS by the tax auditor. So 8 have been notified. So what is required by us, an auditor, to state is whether any adjustment is required or not. Now the moot point is that if no adjustment is required, we don't have to keep the column blank. We have to write nil, no. And if the adjustment is required, we have to write yes. And then clause E states that if the adjustment is required, we have to give what is the difference in the profit or loss. Lastly, I would like to say that this does not require the books of account to be maintained to arrive at the profit or loss as per the ICDS. It has been clarified that the books of account may be maintained or rather are to be maintained as per the accounting standards and per the Ind AS standards or whatever is the applicable, the non-corporate assessee. I was just going through before this lecture. I had earlier not gone through that 32 accounting standards are there and 25 have been notified, level 1, level 2, level 3. So all that has to be seen by the tax auditor, which I am not commenting upon. But as far as ICDS adjustment is concerned, he has to make that and report here. Whatever is the ICDS adjustment, that is to be reported in clause 12E. Now, I would not like to state anything more on this. Let Pramodji say, because time will not permit us to discuss in detail.
I mean, thank you, Satish ji, very right. In 13 A, B, C, D, E, F, if I talk about, Satish ji has discussed about the basic A, B, C, all the three accounting method. I'm not, whatever he has discussed is perfectly correct. Very fine. I'm very fine with that. Nothing more was observed by the board on that. But yes, as regarding my 145.2, the clause D, one has to take care that adjustment as required to ICDS, whether it is required or not. If there is an adjustment, then only you have to say yes. If it is not, then say no. Adjustment means that something is to be filled in clause D. Something is to be filled in clause E. Sorry, something is to be filled in clause E, that some adjustment, increase in profit, decrease in profit is required in any of the 10 ICDS. Any of the 10 ICDS, if there is an adjustment, then for clause D you have to say yes, otherwise no. What the error was found by the board in most of the, not most, in many of the tax audit reports was in clause F regarding disclosure of ICDS. Whether or not my clause D is no or E is nil, clause F is required wherever there is an accrual system of accounting and there is a tax audit. Wherever there is an accrual system of accounting. In case of cash system of accounting, even clause F is not applicable. Whether it is a chartered accountant firm who is following cash system of accounting, clause F is not applicable. But yes, if it is an accrual system of accounting, then yes, clause F would be applicable. And there, as Satish sir rightly said, 8 clauses are to be reported, and there the disclosure, it is not any figure, it is a wording. And what was observed, that sometimes or many times we are not understanding what is the disclosure out here. Each of the ICDS, out of 10, only 8 ICDS, in the end of the ICDS contains a para for disclosure. That what is the disclosure required? Please don't think that anything new I have to create out of myself. In each ICDS, out of 10, 8 ICDS, a paragraph is there for the disclosure that this is required to be disclosed, and that is required to be disclosed in 3CD para 13 F only and nowhere else. Nowhere else, not in the notes to accounts, nowhere else. So let us take just one or two example. Now suppose ICDS 1 I say. So ICDS 1 talks about my significant accounting policies. It cannot be different. It has to be same which I have prepared for my books of accounts. So what is given in my notes to accounts? So here I have got two options. One, either to just copy paste the whole accounting policy and put it here, or I just refer to my note to accounts, the significant accounting policies para. What I personally prefer is referring to it, because suppose every year you change, you may not change every year the 3CD, that paragraph. But what I have observed, that I would say the board has observed that in various cases what is happening, that in other ICDS, what the disclosure is made only if there is a change. No, if that ICDS is applicable to it, for example, borrowing cost, for example, my tangible assets, if those are applicable, then whatever is the disclosure required, I have to give that. So for tangible assets, I refer to clause 18. But in case of companies, I have to be very careful, because the ICDS says that the entity has to follow the depreciation as per Income Tax Act. My books follow the Companies Act. I cannot make adjustment in clause E because I am doing it in my ITR. So in that case, following the whole ICDS system, the disclosure what is required in each of the ICDS end of the paragraph, that you have to mention, and not merely if there is any deviation or any change. So relevant disclosure what is required, if it is verbatim same as compared to the disclosure requirement which is there in the AS also, because they have been taken merely from the AS. If it is verbatim disclosure requirement same, for example, borrowing cost it is same, inventories it is not same, one or two differences there. Right. So case to case basis, if it is verbatim same and you have, the disclosure is made in the notes to the accounts, then relevant sub portion, sub para of that significant accounting policy may be referred here, and not the whole balance sheet, whole profit loss, or the whole significant accounting policy. If it is 2.4 of the significant accounting policy, mention that. Let us be precise what we want to refer to. So this ICDS disclosure 13F, we need to improve. We need to improve. Right? Thank
So,
you.
Pramodji, if I conclude your discussion in this 13F, irrespective of any change in the ICDS impacting your financial balance sheet or tax audit report, you have to comment on every ICDS. Applicable,
Which is applicable.
not applicable.
No. Which is applicable. Out
If
of
something
8
is not
ICDS,
applicable, you have to say not applicable.
No, nothing.
Not required to mention.
No. But if that ICDS is applicable, suppose I have borrowed certain amount, entity has borrowed certain amount, even say from directors. So borrowing cost is applicable.
So those ICDS which are not applicable, we have to mention NA or no?
No. That will not be added. That will in the software also not added. No need to comment upon. For example, I'm not having any. For example, I'm not having. I'm a service industry, no fixed assets. So ICDS 5 not required.
Okay, and we have seen in many reports. What is your opinion about the uploading of the audited financial statement on the portal?
Ranjit sir, very, very important point, because we have seen that they have not uploaded that financial statement. Now, if I am uploading my 3CA, 3CD, 3CA says that these financial statements which have been audited by myself or someone else is being attached there with. So that has to be attached. Because again, I'm referring to my accounting policies mentioned in that financial statement. I have to. Financial statements are audited, have to be uploaded either under the Income Tax Act or under the other law. Both have to be uploaded.
Okay. So thank you. Now we are moving forward to clause 40, and it is again a 145A method of the valuation of the stock of what was in the previous year, and if there is a deviation, then what is the effect on the P&L? So you have to furnish this thing. So what is the very comment on 145A? Both of you want to highlight some points.
I think I incidentally mentioned this along with the my deliberation of the previous. So I will just add only two small issues. One is that it says that method of valuation prescribed under 145A. Now that 145A prescribes inclusive method. Inclusive method in one word means we have to include the duties in the purchase and sale and the inventory. The overall impact will not be there. Exclusive method is that we don't, that is normally what we follow, other than the listed companies, etc. That we don't include those taxes, duties, etc. And we exclude them. In fact, there is a divergence between what this says, 145A, and what the Ind AS, etc. also says for listed companies. They have to follow that. In fact, there is a specific requirement that you don't have to include those things. But anyway, all that is not the subject here. So that is the irony, that there is no symmetry between the income tax provisions, company law provisions, and the accounting standards. Somehow or the other, that effort has to be there so that for all assessees, these three types of different set of standards are not required to be followed. But having said that, we have to mention if there is a change in the method of accounting of raw material, working, finished goods. These are the three type of items normally. And in the method of accounting, as I said, it could be FIFO method, average method, LIFO method, whatever. And then AS on accounting of inventory has to be followed. I am not commenting on that. So I think I will be very brief, and that is sufficient. Pramodji has to say something. Let him say.
Yeah, very rightly, Sarish sir. I will not be talking about 145A because this 145A section is since now more than 20 years under statute. Though there is an amendment, but again the basic intent remains same. So I'm not talking about that. The adjustment, if anyone has to see, kindly refer to the tax audit guidance note 2014, the para 23 of the tax audit guidance note. After GST, the specific paras 23.18 to 23.24, where they have explained the inclusive method, exclusive method, how it is to be disclosed in this para, the increase, decrease, everything has been given there. I'm not talking about that. One or two point here, when we talk about the method of closing stock, we are talking about the valuation of closing stock employed. As per our guidance note, and what should be prudent is that we should mention the valuation of my closing stock of each and every item. Raw materials, finished goods, consumable stores, and stock in trade, spare parts, whatever is there in the closing stock. However, when I see the schema, there is only one line. Either mention all. If you are for this, write each and everything. You have to mention, otherwise in hard copy include everything. And one line which we are mentioning for, suppose I am into trading of goods, nothing else. Yeah. So what I am writing normally, that at cost or market price, whichever is lower. This terminology which we are using is not correct, and that is not in consonance with ICDS 2 as well as AS2. The correct wording is that my closing stock inventories are valued at lower of cost and net realizable value. Cost and net realizable value lower of. It is not or, and it is not market price, it is net realizable value. So one thing one has to be very, very careful for every, not only for this 3CD, for the financial statement also. And second very important point is, second important point I will take in point number 15, which would again come in point number 14. So let us go for 15 and then.
Okay. So now we are moving to point number 15, where you have to give the particulars of the capital asset which will be converted into stock in trade. So all the description of the asset, acquisition, date of acquisition, cost of acquisition, and amount at which the asset is converted into stock in trade. So this is the 4 points in point number 15. So your take on this point.
Thank you, Rajit. See, as per the reporting requirements, they are quite simple. Description of the capital asset. Suppose I am a share broker and I have put certain shares in my asset, capital asset. Why I am telling you this is because they are to pay max. So, irrespective if I am a corporate entity, this is what is practically happening also. Because even if capital gains was exempt or was at a lower rate, MAT is there. So, normally this is resorted to by share brokers, etc., or those others also. But here the example is that. So, they convert their investment of shares into stock. So they have to mention what is the capital asset that they have to mention. Let us say it is shares or securities. Then date of acquisition, when they acquired it. Then cost of acquisition. Amount at which the asset is converted into stock in trade. Now first three are historical. Now the fourth one is important. Amount at which the asset is converted into stock in trade is relevant for the taxation also. What happens? I convert my shares, I am going with the same example. Let us say on 30th of September. These are listed securities. Now, this is 30th of September, whatever is the stock exchange rate, it is quoted there. So that will be treated as the fair market value of the capital asset on the date of conversion. I pass that into my books of account, the entry on that date and that value has to come. And that is relevant from the tax point of view because ultimately when I sell that stock at that point of time, whatever is the difference between the cost of acquisition and my fair market value on the date of conversion to stock in trade, that I am still allowed to treat as capital gains and will be taxable at a concessional rate. Whatever the loss or profit that is after that date, that will be treated as business profit after the conversion to stock in trade. This is, see, I have tried to complete on dot by 8 o'clock. So this is by way of an example I could give. So whatever Tamoji and you have to say, kindly go ahead.
Thank you, Satishji. Here the conversion, very rightly said by Satish sir, 45(2) applies and you convert during the year, but you pay tax or the capital gain in the year in which it is sold. Now the question here is that I have the assessee has converted during the year, but not realized it, and sale has been made say after 2 years later or 1 year later, the next financial year. But in this year, when you have converted, you have to mention this detail. Now, here it could be not shares, it could be immovable property, it could be jewelry, it could be anything. Now, here it would be the main point is amount at which the asset is converted into stock in trade. Now, if I take a case of a company or a partnership firm or an LLP where I've got an immovable property and it converted into stock in trade, I'd got a huge plot of land, which was an investment. I converted. I want to make it a pieces and then sell the plots. So when I convert it, at what rate do I convert? Now the issue here would be if in my books and here I convert it at my circle rate applying 50C. Capital gain would be as per 50C, I agree. But when I convert in my books at my fair market value, then as per AS2, the inventory, I have to give a note, I have to give a qualification that it is not at my cost. The inventory should be stated at cost or net price value, the lower of that now. But here it would be at the fair market value. So 14 comes when I talk about stock in trade, which includes the stocks which are converted from capital to stock in trade. There is no bar in recording that, because what will happen? Let me take a case of a company or a partnership or an LLP. There is a capital asset whose amount in the books is 1 crore rupees. The fair market value or the circle rate I say is 10 crore rupees. So the books are inflated and my reserves are created through profit loss account for conversion by 9 crore rupees without paying tax. So my stock increases to 10 crores and my reserve, that is again not a revaluation reserve. That is not a revaluation reserve. That is an unearned profit which will root through profit loss, and if the MAT is applicable, I'll have to pay the MAT thereon. So in my view, if it is done at the cost itself, there is no bar. There is no bar. Of course, the calculation would have to be kept in mind, and then at the time of paying the tax, again you have to calculate between the two. But if it is done at the fair market value, kindly see that a proper note, proper qualification disclosure is made in the notes to account and the audit report that it is at the fair market value, the conversion done, the recording in the books of accounts. The recording in the books of accounts. If it is a jewelry, of course, you need to have a valuer report out there. So this is a small point becomes. Ranjit sir, these 15 points we have covered, but we have got lots and lots of questions, I would say. कितने अभी थोड़े ले सकते हैं, not all.
Yeah, we can have a 5-10 minutes question answer if you can take some important ones.
Abhayji from Solan, you just said kindly repeat where to find the guidance note related to 145A. I'll just repeat. Refer to ICAI guidance note on tax audit published by the ICAI 2014 issue, revised issue. There, para 23, the whole is for the inclusive and exclusive method. And after GST, the specific paras are para 23.18, 23.18 to 23.24. You just read it, your concept on the inclusive method and exclusive method would be very, very clear. Right? This question was raised by one or two people. Whether clause number 15 will have any, Balakrishan ji, whether clause number 15 will have any impact on the clause 13? No, it will not be having any impact on clause 13 per se. It will specifically not. If it is converted, then of course the disclaimers to be given. There is no loss or profit where the income tax would be impacted. But yes, to the extent of taking it at my fair market value, to that extent the disclaimer is to be given. One question was from Ravinder Kumar Agrawal ji, New Delhi, while submitting the ITR of the company or other entity, whether financials are also required to be uploaded. And Kanhaiya ji from Surat, in case of uploading of audited balance sheet and profit loss, can only face of balance sheet and profit loss account is allowed, or we have to upload the notes to account also? Satish sir, your answer on this, please.
I think you will be a better person. Compliance part, I am very weak.
Yeah, okay, sir. Please see that when we say financial statements, whatever we have audited, the whole has to go. It is not a skeleton one page. It has to go. Notes to accounts are forming part of the balance sheet. Without notes to accounts, there is no financial statement. So balance sheet, profit loss, in case of companies, cash flow statement and notes to accounts, all have to be uploaded. All have to be uploaded. One question again from Atul Agrawal ji from Khanna, dear friend, who says, can we refer the disclosure of ICDS to notes to the accounts? Satish sir himself told that, specifically he said that ICDS is not for the purpose of my books of accounts, and financial statements are as per books of accounts. So in notes to accounts, there cannot be ICDS disclosure. In notes to accounts, there cannot be ICDS disclosure. ICDS disclosure is only and only here at 13F, nowhere else. Satish sir, your input here again, Atul Agrawalji from Khanna, whether stock records are mandatory to be maintained where it is not possible to be maintained, and in case where there are a lot of raw materials, how should the auditor report in 3CD?
I can answer on the basis of two things. First, as per the audit report, tax audit report itself, the clauses which we have not taken, principal items traded, etc., we have to report. Now, that principal item, as per the guidance note, is 10% in value. Now, those 10% in value, you can broadly put that into one category. Let us say, if you have 20 type of small items, you can put it in one category, like shirt, 32 size, 34, 36, 10. Then ladies dresses, all sizes, and this is also supported by Delhi High Court in judgment, and 2-3 judgments I have also argued in tribunal, which the department has not gone into High Court at all. So as far as that is concerned, now strictly speaking, stock register is not required to be maintained as long as you are able to arrive at the correct profit. Now, there are number of cases where there is no stock register, but there is a complete quantitative tally of the incoming and going found during the course of survey or DRI search. I can refer the name of the judgments also, but anyway, the name of the judgment is Univer Telecom Limited. That is a Delhi High Court judgment. It was argued by me in the tribunal, in which there was a DRI search, and yet books of account did not contain this property. But anyway, no adverse view was taken. But I will not advise you to go by this aggressive advice. The right course of adoption would be to maintain the stock register. If there are more items, then you can club it into category wise. I would not advise you to go by academics and take your case to High Court or Tribunal, come to a final conclusion that it is not required. The best course would be to maintain it and to maintain it in a manner as I have suggested.
A very interesting question from Rakesh. Look at the point which I said, Rakesh Bhargavaji from New Delhi. And reading this question brought a smile on my face. As per the tally, if books of accounts are maintained, it is very interesting for everyone to understand. If as per tally, if the books of accounts are maintained, it creates various reports like ledger, sales register, purchase register, etc. should be right, all such reports as books maintained. क्या कहते हैं सतीश सर?
Sir, देखिए, books of account, we will have to go by the definition in the income tax. As per the Companies Act also, now section is, I think, 212. Let me read it. I don't know. I had never had the occasion to go into such depth on this issue. But books of account is 212A. So let me read it. Books or books of account includes ledgers, day books, cash books, account books and other books, whether kept in written form or as printout of data stored in a floppy disk, tape or any other form of electromagnetic data storage device. Now, if we go by this definition, probably they would qualify.
Yes, sir. So we just enter into tally and so many reports come. So all those are books of accounts. So mention that. Very interesting point of case for the members of all. Lots of questions. I'm just taking a few. Dipesh ji's question from Pune. Will the trust audits be considered as audit done under any other act? You know, if I talk about trust audit.
Under what act?
Under what act? In case of a society, the society registered under Societies Registration Act 1860, of course that would be audited under that act. But not a mere trust. If it is under a public charity act and that act requires an audit, then it would be under another act. But again, in case of trust, there is never a 3CD. In trust, there is never a 3CD. There is only 10B. Anil Sharma ji from Panchkula. LLP established 30th April 2020. GSTRN dated 31st July 2020. First sale invoice dated 1st September 20. What will be the previous year in such case? Books of accounts starts from 30th April.
प्रमोद जी आपने आंसर देना इसका.
You know, Sharma साहब आप समझिए कि what is the setup? Setup के लिए there are umpteen number of judgments. It has been held that even if you give an order for purchase, that is a setup. You employ a certain person, that is a setup. So see from case to case basis. See from case to case basis, right?
Judgment is required.
Yeah. Nand Kumar Khandelwal ji from Mumbai, on conversion from company to LLP, PAN remained same, but status changed to LLP. How to give to tax audit report? I am very surprised to hear this, because when the status changes, the PAN number also changes. It cannot remain same. It cannot remain same. You have to apply for the new PAN. I don't know whether you have done practically or this is a theoretical question.
It's a theoretical question. I can assure you it changes.
There are lots of questions. Jatinder Sharma ji, again a very dear friend from Jalandhar, he says, should we mention in books examined the GST returns and other statutory returns thereof? Satish sir.
See, there is no end to these type of things. My view is these are already available online and you have examined them, no doubt. But if we go to that length, perhaps there will be so many other legal records. You could simply write category legal record or whatever you want to say, because there will be no end to my view, because TDS returns are there, then your other returns will also be there. I will take your view, but this is my personal view.
We say list of books of accounts and nature of relevant documents examined. When we say relevant document examined, so here, of course, it would not be books of accounts to be covered under 11B. But when we say relevant documents examined, I suppose there this GST returns should be mentioned, because we are talking about. But again, GST returns are not the. What is to be examined is the source document based upon which the entries are made. So GST return is not a source document. So vouchers, etc., those are there, but invoices, basics are there, but not the GST returns in my view. What I can say.
So it's not a source. Yes.
We have already exceeded time by it is now more than nearly 20 minutes. We have gone extra, so I'm not going further. There the questions are around 100 questions are there. I'm not going. I have to search.
You can answer them on mail if they want, or you can pass it on to me. Some of them I will answer them on mail, and you can then post it if you want. Because the interest of the viewers has to be kept in mind. They have listened to us patiently, rather they have borne for 2 hours, so they need to be given space to be answered. Because otherwise the deliberation does not make sense.
One question is, of course, what is the difference between cost and or NRV? There is a huge difference between cost or NRV. Cost is my actual cost, historical cost. NRV is the net realizable value, which is my selling price less the cost incurred to make that sale. So there is a huge difference between cost or NRV. But I suppose we should close here right now. Thanks a lot, Satish sir and Ranjit sir. Ranjit sir,
first of all, I must thank both the Satish sir and Pramod bhai for very comprehensively taking all the 15 clauses in a very detailed way. Although some clauses are looking very simple, but when you analyze, it looks very, very difficult. So the member has to be very, very cautious while reporting these 15 clauses. Of course, this was our webinar for only 15 clauses today. Next 2 webinars, we will cover entire rest of the clauses, all the 44 clauses, and hopefully within 15-20 days we can have another webinar for other clauses. But whatever discussion took place today, it was very eye-opener. Even we deliberate in our tax audit quality review board many common errors, many issues. So the way you have, all the people have deliberated, it's a very, very enriching for the participant who has watched this webinar. More than 2,200 members are logged in right now who has watched this webinar. And I would like to thank all these 2,200 members for very patiently 2 hours 20 minutes they are watching. And today is a very, very important day for all of us. That's why this webinar is very important today. Today is the 21st day of 21st year of 21st century. So
moving ahead.
This day is very important to all of us. So on this happy note, we conclude with this webinar, and hopefully next webinar we will Pleasure to have all of you in addition to other members for this event. Once again, my thanks to Pramod Jain, chairman of this board, very meticulously analyzing each and every paragraph, clauses, sub-clauses, and enriching the members. So as Satish Agrawal ji for giving very bird's eye view and with the relevant citations. All the case law you have mentioned is very, very helpful to our members. So both of you very, very thanks to once again and all the participants. Thank you. And thanks to Mukta, the secretary of this board, and all the staff technicians for very well organized this webinar. So thank you all of you.
Thank you to all the listeners and everybody. Thank you.
Thank you.